Good evening, everybody. My name is Matt Kirby, and I'm Managing Director at Hamilton Capital. And Jen and I are so very excited to be with you. Thanks to Catapult for giving us the opportunity. And we first wanted to say we appreciate you guys taking time this evening, spending time with us instead of watching the first NFL game where Taylor Swift is going to be in Kansas City. And so we appreciate you guys taking the time and being with us. So we're going to get started, and financial independence is what we're going to talk about today. And so there's a number of things that we're going to address. The first one is defining and achieving financial independence. The second thing is addressing a few core areas of financial planning. We're going to talk about your plan and your practice and give you a quick update on the markets and just a few snapshots of what we're seeing in the world today. And then there's going to be plenty of time for questions. So the first thing we're going to do is we're going to do a poll, and I'm going to pass it over to Jen.
Yeah, so on your screen, there's going to be a poll popping up, but this is to just give us an idea of what in the area of financial independence, what your concerns are at the moment. And we're going to use that to drive, talk about later in the presentation, but also drive some of our future webinars. So it just gives us a pulse on what your major concerns are. So from there, we want to talk about financial independence. So this is one of the things that I love about what we do as planners. Two clients walk in the door, same amount of money, their goals and objectives with those dollars are so wildly different from one client to the next. And I just really enjoy working with that and trying to help problem solve and create plans around that. And the common theme with those clients is really that financial independence piece. And the way we define that is, essentially the who, what, where, when, why, and how. And the who, of course, is you planning for that financial independence. But the when is, when do you want to start working? The what is what lifestyle you're looking to achieve in retirement. Where do you want to live? Do you want to do some traveling? Why is this important to you and your family? And then bringing it all together with how do we make that happen? And we're going to touch on a few of the financial planning areas that relate to that. So one of the things with that, like we said, no two clients are the same. So what we have to do is create some structure around how we address that, because we have to be able to create customized financial plans for each client. So the way we do that is through collaboration, guidance, creating that plan, and then monitoring that plan. So that collaboration really comes between the advisor and the advisor and the client, really understanding who they are, what their goals are, what their story is, creating a plan, giving guidance around what the full financial picture looks like. A lot of times people focus on just, maybe a piece of the puzzle, but really understanding what that full financial picture looks like and creating a plan around that. And then, of course, going into making sure that the investments are aligned with that financial plan. And then what I like to say is that that plan is a snapshot in time. So really just it's going to change tomorrow. The markets are going to change. Life is going to change. So having that be something that you're continuously reviewing and updating over time. On your screen here are the 5 financial planning areas that we're going to touch on today: retirement, investment, insurance, tax, and estate planning. I'm going to start with retirement. So we know from working with Catapult, there's probably a wide range of people on this call today. Some individuals who have just left college and are just left dental school and they're getting started in their practice, maybe some more established dentists, and maybe some dentists that are looking, getting closer to hanging up their dental coat and getting ready for retirement. So we want to really just talk about, what that looks like. How can we get saving for that retirement, and what kind of vehicles are involved there. So when to start saving, I think the easy answer is as soon as you possibly can. Yep. I recognize that when somebody is just out of school, maybe carrying some school debt, and you're trying to get your practice off the ground and you're trying to cover your regular living expenses, for us to say, what, you need to save to your retirement plan, it feels almost insurmountable in some situations. But we really want to make sure we're trying to save in some way, shape, or form. There's a lot of vehicles for that. And it really depends on what your practice looks like as well. So are you a W-2 employee? Or are you an independent contractor? if you're a W-2 employee, does the company that you work for have a 401k plan or some sort of retirement plan? If they do, participate in that. Like I said, anything is better than nothing. So participating in that. If you're younger, certainly participating and being more aggressive with those dollars on how you invest those dollars is going to be important, because you're really not touching them for a long time. And then if you happen to be an independent contractor and you really don't have those options available within the practice that you're working in, you can look at Roth IRAs, SEP IRAs, maybe a solo 401k for yourself, but really just understanding what your options are so you can start building that those retirement savings. If you are the practice owner, you have a lot more options here. Really wanting to maximize your tax savings, you can add additional features to your 401k plan, like a profit share or a cash balance plan, which right now if you can max your retirement savings, it's close to $24,000 right now. But with those other features, you could actually tax defer up to $200,000 in some cases. So if that works for your cash flow, really understanding what those options are and being able to participate in those. Did I miss anything?
No. Well, one thing that we are going to throw on the screen is when we're planning to have future webinars. And so we'll pop on the screen a couple of those just to give you some insight of some of the future webinars that we're going to be offering through Catapult.
Yeah, excellent. So that is on your screen right now. We're going to be doing one in April that is specific to retirement plans and what those options are. So we'll dig into that a little bit deeper. But I'll move on to investments. This is what's really important. You go through all of this work to create this financial plan, but you really need to make sure that the investments and the strategy that you're invested in aligns with that financial plan. So if I'm doing Matt's plan and I'm working through and I say, okay, Matt, like for what you're going to save and what we're going to do over the next 10 or 15 years, you need maybe 7 or 8% return. We need to make sure the portfolio is actually aligned with that. And then on the other side of it, what if you only need 5? Like you don't need your portfolio to hit home runs. You really need it to, stably get those returns. And so it's my practice is really, we don't want anybody carrying any more risk than they have to. On the other side of that spectrum, of course, if you're in a position where you need that portfolio to do more for you to reach that financial independence, you really want to understand what that means and what kind of volatility that you may be experiencing as you have that in your portfolio. Again, looking at some future webinars, we're going to be talking about more details about investment philosophies, as well as giving you like a really detailed market outlook. And then there's another asset class that isn't always available to individuals that's becoming more available. So adding alternatives to your investment portfolio to really accentuate your returns and manage some of that volatility is going to be really important. Excellent. Insurance planning is another area. So, as dentists, you're having to deal with all kinds of insurance all the time, malpractice, liability, health insurance for your team, all kinds of insurances. And it's important to take a step back and make sure you're protecting yourself and your family in other ways. So none of this is super fun to talk about, but certainly if something happens to you prematurely, you want to make sure that your family has the assets that they need. So if you were to pass away early, is that going to be detrimental to everybody's lifestyle? Are we still going to be able to make mortgage payments? Are we still going to be able to make the world go round, college costs, school costs, whatever the case may be? So really looking at having appropriate life insurance. When I talk about that, I really like to say it's important to work with somebody that's like independent, that's going to work with you to understand what your health is, what your needs are, and really not necessarily just try to sell you the most expensive product. For instance, I can't speak for Matt, it's probably pretty similar, but I had my kids and I got term life insurance. So that's something that I'm paying for every year for the next 20 years. So if something happens to me, the mortgage is paid for, my kids get through college. And that's the least expensive type of life insurance that you can get. When I was going through that process, plenty of people were trying to sell me permanent life insurance. Now that has its place in certain instances, but it can be much more costly. So really understanding what your options are there is important.
Yep.
Do you also have term life
I,
insurance?
I do also have term life insurance with young children. That's right.
Excellent, excellent. So same thing with disability insurance. If you are disabled in some way, shape, or form, how is that going to affect your family's lifestyle? If your income ceases because you're not able to practice dentistry anymore, it's going to be really important that you have some protection there. So one of the things I like to mention when you're looking at disability insurance, you really want to pay attention to what that coverage is for. You want it to be for, and I mean this in real air quotes, your own occupation, because there are some policies out there that cover any occupation. So, you know, it's already going to be really detrimental that you've suffered some disability that means that you can't practice. But if you can flip burgers down the street, so now you're not able to get that benefit from that insurance policy you've been paying for years, it's going to be really upsetting as well. And again, still really detrimental to your family's overall wealth. The other thing I'd like to mention here, especially when we're working with dentists, I've had really good success working with dentists that, you know, utilize the group disability policies through the ADA, and then supplementing that with some additional private insurance, which I think is important. Long-term care is another insurance that I think a lot of people put it off to think about later in their years, maybe even not until they're in retirement. But we're seeing a trend of more people looking at that in their maybe early 50s, even sometimes late 40s. And the reason for that is there's been a lot of changes in what's available in long-term care. So I'm a particular fan of these hybrid policies. So that's a life insurance policy with long-term care benefits. But what I like about it for the working professional is that you can actually go through the process, get that insurance, and actually have it paid up by the time you retire. So that's one less expense that you're having to cover in retirement. But again, with all of these insurances, there's a lot of different options out there, and just understanding what your options are. Long-term care, the other thing I like to mention there is that we're not suggesting that you go out and get 100% coverage. That's really cost prohibitive. So, you know, when we're looking at coverage, maybe we're starting at that 50% mark. And the argument there is that you have lifestyle expenses. If you're in a long-term care situation, you need care, some of those lifestyle expenses are going to stop. You're not traveling, you're not eating out, you're not doing all these things. You're now spending some of those dollars on your own care. So you don't need to insure 100% of your coverage.
Yeah, one other thing on long-term care is there is a place for long-term care. A lot of our clients actually are able to self-insure as they get older. And so the more assets that you build over time is going to allow you to be able to sustain a long-term care event, even without coverage. So it is not something that all of our clients pursue. It is a discussion that we always have. It is something that you should consider, but there are other ways that you can insure for a long-term care event without having actual long-term care insurance.
Yeah, great addition there. The other thing I like to mention with long-term care is the reason we want to make sure we have coverage, whether we're self-insuring or we're covering it with insurance, is if there's a long-term care event. So maybe somebody needs memory care for 10 years or something like that. That can be really detrimental to the surviving spouse's financial situation. So that's what we're trying to avoid. And that's why, you know, providing some insurance there or making sure that we're self-covered well beyond what our potential needs would be is important. Umbrella insurance is on here. That's something that's what I joke a little bit, but that's the free advice that we give everybody that walks in the door. That's coverage everybody should have. It's very inexpensive. It's just an additional layer of liability coverage. So, you know, if somebody gets injured in your home or, you know, there's a motor vehicle accident or something like that, that's an additional place that the insurance companies can go for that settlement benefit before they're coming to your personal assets, which are hopefully also protected. And then finally, coming back to your practice, you know, having key man insurance or buy-sell insurance is going to be important. If you have a practice where you're the sole dentist, then you probably want to have some key man insurance. So if something happens to you, you know, the benefits can move around to some of your other associates. Or if you have maybe multiple partners in a practice and you have some sort of agreement where if one person was to pass, the other partner will buy out the existing partner for that part, the deceased partner's family's benefit. You know, you want to make sure that those agreements and policies are in place, if that makes sense for your practice. That's not necessarily for everybody. Anything else on,
No.
okay.
No.
Thank you. Tax planning. So I think it is safe to say that the majority of people want to keep as much of their dollars in their pocket as possible and really minimize what we're paying in taxes. So that comes with tax planning. So you really want to make sure that you're working with your CPA or other professional team to ensure that you're talking to them about what's going on during the year and that they're talking to you about what's going on in the year. And I mean this inclusive of your practice, because there may be strategies as the laws change from one year to the next, where there may be additional ways for you to maximize your income and minimize your taxes, and really adjusting, making adjustments along the way. I really like to, I have CPA behind my name, so I like to push this a lot, but try to get that tax planning done before December 31st, because sometimes some of these things can actually be implemented prior to year end. I also really like that. I am I really don't like tax surprises. So I really don't like tax surprises for our clients either. So making sure that you're working with a tax planning specialist and really sharing with them, your projections for what's going on for the year, but then having that person share back with you, what's changing from one year to the next. So we're on the cusp of some sunset provisions. So we're going to see some additional taxes unless some of the legislation's changing. So we're just going to want to pay attention to that. We've also seen increased interest rates. So that's, resulting in increased interest income. And sometimes people are surprised by that too. So making sure that we're talking about that.
Yeah, the only thing I would add is within your practice, what we see a lot of successful dentists do is make sure that you're keeping up with your books on a monthly or quarterly basis. So if you're getting into the fourth quarter and you're doing tax planning, but your books are behind, a lot of times it's extra effort to keep up with kind of where you may end up for the year with your tax burden. So it's always a great idea to make sure that your books are up to speed so that you can use accurate data when you're actually doing your tax planning in the fourth quarter.
Yeah, excellent. Thank you. All right, so estate plan, people are just as excited to talk to me about passing away as they are about their taxes. So this is really important. I think this is something that we focus a lot on when we're working with our clients, and it's because we've seen the bad. We've seen families come in where a family member has passed away and an estate plan was not in place, and it's kind of a mess, and you really don't want to do that. So as much as you can plan and provide clarity for your family, they're already going to be really upset that you're not here. So we don't want them to be upset and confused about whatever mess has been left behind. So really creating a plan to ensure that your assets flow the way that you want them to, and that you're continuously thinking through that and working through that. It's our goal to try to avoid probate whenever we can. So really just creating that estate package. That baseline package is a will, durable power of attorney, healthcare power of attorney, and really just some baseline documents. A lot of times with our clients, we end up seeing irrevocable trust or revocable trust. So really working with an estate planning attorney that understands what you have going on and making sure that works. If you happen to be getting close to the estate tax exemption, which right now for a married couple is almost $27 million, but it's about to be about 14 million if nothing changes as of the end of next year. So as you're getting close to that, understanding what some of the options are around planning for those sunset provisions, because again, we're trying to avoid paying taxes as much as we can. There's a certain extent you have to pay them, but if there are strategies to move assets to your heirs where you don't have to pay taxes, either through gifting or trusts or whatever the case may be, it's important to look at that. Our rule of thumb is to say, okay, you have estate documents, wonderful, I'm so proud of you. We usually have to nag clients a lot to get that done. I've got a few clients that are probably really upset with me right now for nagging them about this, but you've got them, great. Look at them every 5 years. Just have your attorney dust them off every 5 years, because again, life changes, but life events, like major life events, should trigger that second look earlier. So if you buy a house in another state, you have a marriage, a divorce, adding kids to the family, those are all like major life events that you want to make sure that you're updating your estate documents for. But if none of those things are happening, then go ahead and, at least dust them off every 5 years.
Yeah, one other addition that we see is that a lot of the business assets that are in the name of the practice, if you're a practice owner, just also making sure that that is also included in your overall estate plan. A lot of times that is an asset that is owned individually by you as the owning doctor, making sure that that's going to be handled in the event something were to happen to you in the way that you want. A lot of times we'll also see inside of a trust, naming a business advisor that could be a good friend that's in the dental community that can be there to support a spouse or your heirs in the event that something happens. So just another thing that we see quite often with the dental community and their estate plan.
Excellent. Yeah, great addition. And some other planning areas that we want to touch on, but again, I think you'll see these come up in future webinars, is succession planning. So again, always making sure that your practice is a part of that conversation when you're talking about financial planning, tax planning, estate planning, all of that. But at some point you may not want to be in the business anymore. You really want work to be optional. That's what we're going for with this financial independence. So, what is that succession plan? Are we selling? Do we have other associates that we're, grooming to take over the business? Really understanding what that looks like, what some of the other options are. So we're going to dive into that in another presentation. Education planning, that could be for your own kids, for your grandkids, doing some planning for their college costs. Charitable planning as well. This is a great tool that we use a lot on the tax side. Is if you're already charitably inclined, but maybe you have some highly appreciated stock in your portfolio, that's a great use for some of your charitable giving. You can put it into a donor advised fund and divvy that out over time, or you can do it directly to the organization in the year that you have it. There's some tax advantages to both. Gifting, we talked a little bit about. That's a way to get some assets out of your estate without creating any tax. So right now that gift tax limitation is $18,000. So I can give Matt $18,000. I don't have to file a gift tax return. I could give Matt and his wife $36,000. Hopefully you'll give it back, but just something to consider there. And then one of the other things that has come up a little bit, and I think we're going to talk about it a little bit later too, is debt financing. So in your practice, as you're buying equipment, really understanding, what that looks like long-term and incorporating that into your overall plan.
So Jen covered a lot of different planning areas, and how do all of those impact your overall financial plan? So one thing that we always recommend for any one of our clients, dentists in particular, is how did you arrive at where you are? So clearly understanding what are the habits, whether it's spending habits or your income, or how did you arrive at where you are today? There's generally some strengths that you've done some great things financially. Sometimes there's some weaknesses, but just getting a general sense of where you and your family are generally is a great place to start. We always like to define objectives or goals for a lot of our clients. And so I think this is something that you can do not only for the health of your own practice, but for your own financial well-being and your financial independence targets. So a lot of it's long-term objectives. Where are you going? Some of those actually can be a lot more shorter term. So what do the next 6 to 12 months look like? What does the next 3 to 5 years look like? A lot of times if you're planning for something that, if you're a younger dentist, you may be looking at being financially independent in 20 or 30 years. So maybe those shorter term objectives are a lot more meaningful for you in the moment. So a lot of times what we do is we coach our clients on making sure that you have clear objectives of what you're shooting for. Once you have objectives, then we really spend a lot of time organizing all of our clients' financial assets. So I think that this is an exercise that you do within your practice with P&L, your profit and loss statement, and your inflows and outflows statement, and the balance sheet of your practice. We always build those for our clients' personal lives as well. And so what I'm going to share with you is just an example of a financial statement and just give you a little bit of a sense of what are the things that we're trying to look at when we're reviewing a financial statement. The first thing I'll talk about before we go to the financial statement is the actual value of your plan. 20, 30 years ago, most of our dental clients their plan was driving their income, but they did not monetize their plan as they got towards their financial independence target or towards their retirement years. And so one thing that I have on the screen is just kind of a broad example of how a lot of plans are, or how a lot of practices are valued today. So in this example, we have practice collection. So this is not necessarily production, because a lot of you are going to write off some of the work that you do. So this is the actual collection that the practice will receive. So in this example, it's 1.8 million. The expenses are about 70% in this example. So 1.26 million is your salary and your staff and your marketing and your rent and all of your labs and your dental supplies. A lot of times we like to see that in the 60 to 70% range versus your collections. And in this example, we have doctor compensation, which is different from practice profit. And so doctor compensation effectively is you working as a doctor inside of your practice. What are you producing as the doctor? The practice profit is what are you being rewarded for being an owner of the practice and taking on the risk of ownership. Now, for those of you that may be associates, you may not have that highlighted line. So for you, it may look a little bit different, but using this as an example, this would be for the practice owners that are on today. So if you add your compensation that you have earned through your production, and you have the profit that has come from rewarding yourself as taking on a risk of being a business owner, the aggregate compensation in a given year would be $540,000. There's a lot of different valuation methods that we see across the board. What we're seeing more often than not is that most buyers, whether it's a DSO or whether it's an associate or whether it's an external party, most of the time they're looking for purchasing the profits. And so you can look at that as net income or EBITDA. In this example, most of our practices that we're seeing are probably 6 to 10 times their EBITDA. So if you're at 270 as the practice profit, then the valuation of your practice could be 1.6 to 2.7 million dollars. That can be a very large asset that'll propel you into financial independence. So what we do for a lot of our clients when we're analyzing their plan is we try to come up with a solution that gets them as close to financial independence as possible without needing to rely on the sale of the practice, knowing that that could be a pretty large kind of jump start that gets you into financial independence when you get towards the end of your career. So this is, you probably can't see a lot of these numbers, but it is an example of a balance sheet or a net worth statement. And a couple of things that I want to highlight. The first thing is that we always want to understand the liquidity, not only within the practice, so how much cash do you have available, but also how much cash you have personally, because liquidity offers flexibility. What we're seeing a lot right now is that borrowing money is becoming a little bit more expensive. And so potentially using cash to make purchases for not only assets that you may need inside the practice, but we're seeing a lot more clients that are wanting to purchase cars outright or do home improvements outright. So building your kind of non-retirement or your liquid assets with cash and money market funds and taxable investments is critical. The second thing we have in here is qualified assets or retirement assets. The reason why we emphasize those is most of the time, those are very tax efficient ways to save. So if you have a pre-tax IRA, 401k plan, defined benefit plan, you're getting a tax deduction up front, allowing those assets to grow tax deferred. And then you're eventually taxed on those when you take out. Another great tax efficient vehicle way to save is a Roth IRA or a Roth 401k where you pay the taxes up front. Build that over time, and then that is never taxed, whether it's the growth of the asset or it's when you take it out in retirement or for a distribution down the road, it's never taxed. So we like to see a good balance. We also like to keep track of the business interest, whether it's cash, whether it's the value of the actual asset, whether it's a building that you may own for your practice, and the value of the practice as well, because a lot of that does feed into eventually your financial independence target. The final thing I'll have on here is debt structure. So debt structure is part of how most people finance their practices. It's how most people finance their education. It's how most people buy their homes and their office buildings. And so your personal and your business debt does impact your personal and your business cash flows. And eventually, hopefully, those are assets that you are borrowing money to buy that eventually, as you pay those down, becomes good, a great asset that you can add to your balance sheet when you become financially independent. So this is a quick snapshot that I wanted to share what a healthy cash flow allocation is for a lot of our dentists in particular. And so what we like to see is that of the earnings that you generate within your practice or as an associate, is that a healthy allocation would be that you're spending about 50% of what you are generating in income, leaving about 20% for your savings. So 20% of what you are earning on an annual basis, we like to target that as a really strong savings rate. And then obviously, as Jen alluded to, you're going to have a business partner for the rest of your life, which is Uncle Sam. And so typically we're assuming that, depending on your income level, that you're in a 30+% tax bracket that is going to be different for all of you that are in high state tax states. Some of you, like Jen, who live in Florida, you don't have to worry about that, but taxes are something that we always want to consider. But we have found that 50% of your earnings can be spent, 20% saved, and 30% generally we're going to earmark for taxes. This, based on that kind of practice valuation slide that I just alluded to, about $550,000 of income, this just gives you a general breakdown of kind of what those numbers are. The reason why we wanted to share this was because if you are used to spending about $275,000 a year, or in this case, around $23,000 a month, your ability to be financially independent, where you don't have to rely on working anymore, we need to accumulate enough assets where you can continue to spend $23,000 a month and never outlive your money. That is the whole objective. So the next slide is going to put that into some context too. When we're looking at a safe withdrawal rate, what a withdrawal rate is the percentage of your entire assets, mostly your portfolio assets, but can include real estate or rental real estate. It's the withdrawal from your assets on an annual basis. And so what we like to assume for our clients that are in financial independence or approaching financial independence is that the return that they may receive on their investments is around 6.5%, that they're able to spend around 4% of that every single year, leaving 2 to 2.5% to keep up with inflation. Most of you have experienced some pretty impactful inflation over the last few years. The Fed's long-term target is going to be 2%. We've experienced much lower inflation for the last few decades. We expect that we're likely going to receive a little bit higher inflation over the course of the next few years. But in terms of a withdrawal rate, this is what we have found to be a really healthy way to look at kind of what your spending habits are in relation to your portfolio. And if you look at that lifestyle back to $23,000 a month or $275,000 a year, what people don't understand is that it takes a pretty large portfolio in order to replace the income that you have enjoyed being able to spend over the course of your career. So in this example, if the withdrawal rate is 4% and you want to spend $275,000 a year, you're going to need to accumulate assets of anywhere from $6 to $7 million. Now, everybody has different objectives of whether they want to leave a legacy to their family or they want to leave a legacy to charity. So you don't have to always stick to a 4% withdrawal rate, but general rule of thumb is that whatever you need to spend on an annual basis, you divide it by 4%, and that is the number that you need to shoot for if you're targeting financial independence. One thing I'll mention is that obviously there's Social Security and there's other resources that may be available to you. We haven't taken that into consideration for this example, but our belief is that Social Security is not going to go away. They may modify it over time, which has been done in the past. But for those of you that are a little concerned that Social Security may not be there for you, our belief is that there is going to be something there. We just know that it may be a little bit different than what you're expecting today. This is another example. If you're thinking about what does financial independence mean, in this example, we have somebody looking at retirement or financial independence in the next 5 to 7 years. And so accumulating assets, continuing to save. The blue bar graphs are the size of the portfolio in this example. What you'll notice right at retirement is that there is a jump in value. And what that is the sale of the practice. Sale of the practice could potentially be the sale of the office building. But in this example, if the person is spending $23,000 a month and they've amassed around $7 million, you can spend that amount, increase it with inflation year over year, and you can see that the portfolio continues to grow over time. And so a bulletproof portfolio when it comes to financial independence is that you're continuing to accumulate your resources even while you are not working. And that's what our hope is for most of our clients, and that's our hope for most of you. We'll just touch on a couple current opportunities for dentists that we're seeing. One is cash management and liquidity. And so even though interest rates have come up and we've seen an impact with inflation, the one opportunity that does offer is that if you're sitting on cash within your practice or you're sitting on cash personally, most money market funds at this point are giving us a 4 to 5% yield, which for the prior 20 to 25 years, we
were not getting that.
No, we saw money market funds at 0%, maybe up to 2%. So there is some value in being a little bit more opportunistic with some of the cash that you have. And as I mentioned before, with borrowing costs a little bit higher, having liquidity to pay cash instead of borrow is something that we're seeing a lot of our dental clients do. Office location. So a lot of you may own your businesses or own your buildings. You may be leasing current spaces. What we have found is that negotiating leases, there's a lot of good opportunities for lease negotiations. And depending on location of where you are, we're still seeing pretty good opportunity for buying buildings and moving your practice into a new space. A lot of times there's maybe some older buildings that just need a little bit of TLC. So there's a lot of good opportunities in the real estate market right now. Jen alluded to alternative investments. We see a lot of opportunity in alternative investments, and we define alternatives as anything that is not publicly traded. So stocks, bonds, cash, all of those that are traded on a daily basis, we're seeing opportunity in some of the more unique asset classes that are out there. Reviewing your estate plan, good opportunity to do that. Both the estate tax and the income tax are scheduled to sunset in 2026. And there's a lot of things that you can plan for over the course of the next 15 months that put you in a good position, depending on what happens with the election here in November and what policy changes may come. There are a lot of opportunities that we can take advantage of over the course of the next 15 months. And then the final thing is charitable giving strategies. And I think one thing that a lot of people do is they just continue to give on an annual basis, and they do it out of the goodness of their heart. Sometimes there are more tax efficient ways to do it. And there's a lot of good opportunities for dentists there as well.
The other thing that we had talked about was incorporating maybe other family members into the practice. So
Yep.
Getting that, if you have a spouse maybe that's involved, maybe helping around the office, getting them on payroll, getting them participating in the 401k plan or retirement plan can be a nice way to boost your personal savings.
Yeah,
So.
and actually a lot of times we see that too with the children of business owners that are dentists, is adding them in, getting them to do some work around the office. Maybe they can be part of your marketing plan and you can take pictures of them. But that's a great way to get some compensation down to your children which then allows them to make Roth IRA contributions or other retirement plan contributions, even when they're relatively young, to put them in a good position, not only to kind of understand how being paid works, but also get some retirement savings for those children as well. So I'm going to spend a few moments on giving a quick update on the market. A lot of times when we are speaking with a lot of dentists and others, the market and the impact of the economy and the financial market is something that is top of mind. So we just wanted to spend a few minutes discussing that, because if you are planning for financial independence, your portfolio becomes a lot more of a critical factor the older you get and the larger your portfolio gets. And so the one thing that we cannot control is the market that we are in, but what we can control is how we invest money. And so we have a webinar that we're going to be sharing with you guys here in a couple months, specifically on investment philosophies, a little bit deeper dive on the market. But when you forecast financial independence, most people are going to use a rate of return that is consistent year over year over year. That's what we do for our clients. And so if we're going to forecast a 7 or 8% return every single year with no volatility and no losses, that is the portfolio that we are hopeful to build for a lot of our clients. And so if the objective is to get that, there are 3 major pillars that are critical. Absolute returns, which is a positive return. What doesn't compound is when you have losses or negative returns. And so we always want to have positive returns. The second thing is we want them to be consistent. And so what compounding, when that really works in a good way, is when you have consistent returns. And one of the things that we always want to avoid is large losses. One concept that we'll share briefly right now is the impact of a significant loss and how that impacts what you need to do to catch up. And so in both of these circumstances, on the left side of your screen, this is starting with $1 million and having a 40% loss. Now, this does not happen very often, but it has happened during the tech bubble, which I'm sure some of you recall, 2000, 2001. This has also happened in the great financial crisis in 2008-9. But the impact of a 40% decline is you have to go back up 67% to get back to where you started. What that means is over a 5-year period and over a 10-year period and over a 15-year period, you're going to have to get 12, 18, 10%, just very large double-digit returns in order to get back on track. Whereas you look at the right side of the screen, you have a 15% loss, and it's a 17% gain to get back to even. So getting back on track towards your financial independence goals becomes a lot more, it becomes a lot easier, a lot more reasonable, and a lot more achievable if you can still commit to an 8, 9, 10% return, even after a 15% loss. So a couple quick updates on kind of what we're seeing in the financial markets right now. The first thing is this has been a very unique 18 months. And so it's been higher interest rates that have been relatively new for most investors. The market has really been led by a lot of government spending, a little bit of craze with AI, artificial intelligence, and the impact that that's going to have on the economy. And it's been a relatively narrow market. And so what you have seen even more recently over the last 12 to 18 months is that there's been a handful of very large stocks that have really had a concentration that have really made an impact on indices. But a lot of the broader market has not performed as well. And this is kind of a unique time where we've seen a lot of concentration in a lot of the big names that you hear about all the time: Tesla, Google, Facebook, Eli Lilly, NVIDIA obviously has been the darling. but it's been a very concentrated market. What we're seeing right now is that there's a lot of vulnerability out in the marketplace right now. And so one of the things that we would encourage all of you to do is, as you're planning for financial independence and you have resources that are invested in the financial markets, is to really make sure that not only are you taking advantage of the opportunities, but you're protecting with a little downside risk as well. A lot of times in the election years, we see some rallies towards the end of the years. This may be a little unique given the fact that we have really high valuations in a lot of the equity markets. And so just something that you may want to talk to your advisor about, or may want to review your portfolio a little bit more in depth as we head into the fourth quarter here. What we recommend doing is being a little bit more cautious, making sure that you're not overly committed to specific assets. And we'll transition over to kind of what we really like right now, and where a lot of our clients are currently invested. And one final thing before we get there is, this is just kind of a heat map of a variety of different colors of kind of what's going on in the economy. And so policy, so monetary policy, fiscal policy, and inflation and employment, those are things that are extremely important to what drives asset class returns over time. The economy, there's the consumer, commodity prices, credit, debt burden, both at the corporate and the consumer level, and valuations. And when we look at this as the backdrop of managing portfolios, most of what we see on the screen that drive asset class returns is relatively cautious or pretty highly vulnerable at this point. And so this is a snapshot in time. This is over the course of the last few months, kind of where we are today. If you take that exact same picture and you go back to 2012 or 2013, there's a lot of constructive things that were going on in the markets back then. And so this is not this is an opinion of our investment team today, that there's just some risk that we want to be mindful of. And now we're going to transition back into how Hamilton Capital is positioning our portfolios. And so this is just giving a quick snapshot of kind of our view on the financial markets and what we like right now. So I mentioned before that low volatility is something that we hope to achieve with a lot of our clients planning for financial independence. And so what we like right now is high quality, large cap companies. Most of those are blue chip companies that are stable with low leverage, not impacted as much by higher levels of interest rates. We still really like energy. So energy companies are very attractive. In terms of the price that you are paying for the stream of earnings that most energy companies are generating right now, pretty attractive over the next 18 to 24 months. We like structured credit, which generally is going to give you a little bit higher yield. A lot of that is mortgage-backed securities and other asset-backed securities that give you about a 2 to 3% higher yield than a treasury. We really like treasuries right now because they're very low risk, and they can give us 5+% return without putting a lot of exposure in the portfolio to some of the riskier asset classes that are out there. We actually like some volatility that gives us an opportunity to take advantage of some better prices. So that's in the public markets. In the private markets, private credit, we did mention structured credit. It's just a different way to access structured credit. And hedge funds, those are depending on what type of hedge fund that you are invested in or that you're pursuing. A lot of them are uncorrelated to the overall markets. And so these are just some portfolio positions that we see that if the objective is absolute positive returns that are going to continue to be consistent and avoid large losses, these are the things that we favor today. So a couple of key takeaways that Jen and I just wanted to wrap up with. Defining and achieving financial independence. You guys all deserve to be financially independent. Hopefully soon, if not soon. Hopefully when the time is appropriate for you. But defining, achieving financial independence, addressing some of the core areas of financial planning that not only allow you to get to financial independence, but in the event that life happens, that you're protecting yourself and your family. We talked a little bit about building a plan and having goals and understanding where you need to go, how the practice may fit if you're a business owner, how that practice may fit into your overall plan. A couple opportunities for dentists that we're seeing today, and then a quick update on the financial markets.
As we mentioned earlier, so we're hoping this is like a series of webinars. So the next one, we're going to talk about some of those investment strategies and give a more detailed market update. So our plan is to provide a short market update on all of our webinars, but the one in December will have a more detailed market update as well as some investment philosophies being explained. In February, we're going to talk about that alternatives asset class that Matt was talking about, what those asset classes really are and how you can access those within your own portfolio. And then finally, we're going to talk a little bit more about what those retirement plans like for your practice, what the different levels are. If you have a newer, younger practice, you might consider certain types of retirement vehicles versus others if you're maybe in a more established practice. So we're excited to bring you some more content. And then of course, we'll use some of the information that we received today to kind of drive some of that detail. And I think we're going to open it up to questions. I checked the chat box, and one of the questions we received is whole life insurance a good alternative investment? So I'll go ahead and take that. It's not my favorite as an investment vehicle. I really feel like you're giving up some of the flexibility, and when you do the math on rate of return, it takes a long time for that to be like a favorable rate of return, in my opinion. So especially where we're at with interest rates today, I would rather see clients or individuals saving into their investment accounts and having that flexibility, not necessarily giving up the liquidity. I know it's accessible as a loan once you've built up that cash balance, but you're giving up the liquidity for a long time before that cash balance is really available to you.
Yeah, the only other comment is there are times when whole life or permanent life insurance makes a whole lot of sense. What we typically like to see is a separation from investments and insurance, because ultimately, if we're building towards financial independence and you have amassed enough resources, whether you're 50, 60, or 70, the need for life insurance becomes obsolete, in our opinion, for a lot of folks. So generally, we like to use term insurance to kind of fill that gap, but there are some times when whole life insurance or permanent life insurance makes sense.
Another question we received is, are annuities a good investment?
Yeah, so annuities offer a lot of different features. Generally, they're higher fee products, and generally they pay the agent or the advisor a relatively large commission. A lot of things that people like about annuities are sometimes they have some risk protection where they'll put in different barriers where in the event that the market comes down quite a bit, that they'll have kind of caps. And then there are some income benefits for annuities as you're approaching retirement. So there are some instances when annuities make sense. A lot of times, no different than the whole life products. We tend to look at, because annuity is an insurance-based product, a lot of times we'll look at insurance and investments and treat them separate. Mm-hmm. We don't sell any insurance, and there are some annuities that do make sense. Typically, that's not the first thing that we recommend for most of our clients.
Yeah, and what I'll say to that is, if it is something that you're looking to incorporate into your portfolio, it is my first instinct to say, like, just a piece of your portfolio in an annuity. I know, like, I've had clients in the past where they had that as like I call it like the pillow factor. That little bit of guaranteed income, that little bit of insurance on the portfolio helped them to sleep at night a little bit better. But don't do it with all of your assets. That scares me. Yep. We had a couple other questions here. What is the onboarding experience with your company, and how long in your experience does it take most dentists to reach that financial independence? So,
Ooh, that's a good one.
yeah.
It's a good one. I'll handle the financial independence.
Yes, go for
one.
that.
In most circumstances, a lot of dentists are coming out of dental school in their mid to late 20s. And I would say our most successful dentists that are committed to financial independence, they're committed to saving 20% of their income on an annual basis. Typically, you can get there in 30 years. It seems like a long time, but when you're 28 years old, retiring in your late 50s or early 60s is very achievable. And I would say most of our experience has been that a lot of times people don't get there until they're at least in their mid 60s. So going back to, as you're building financial independence, the sooner you start, the better off you're going to be. But I'd say on average, it's probably about a 30-year time frame, unless there's other factors that impact someone's portfolio or assets.
Sure. And that last question, onboarding experience with your company. So I think that's a very hands-on experience is how I would describe it. You know, we're really taking a lot of time on the front end to understand what you have, how it's working, you know, where the opportunities are, where can we add value, and then walking alongside our clients as they onboard into the HC family.
Yeah. Well, and I think one thing that may be a little unique about what we do, and I would encourage those of you that work with advisors or are looking at potentially working with one, is we work on a team here. And so when you hire Hamilton Capital, you don't hire just me or just Jen. So we typically have anywhere from 3 to 4 people that are integral to every relationship. And so it's not just a one-man shop, but you know, no different than how you guys are trying to build a sustainable business. That's the model that we've tried to build, is that we go much further than just 1 or 2 advisors. And we like to have multiple sets of eyes and ears on every client.